Picture this: two traders sitting side by side, looking at the same stock, the same option chain, the same market data. One walks away with consistent profits month after month. The other bleeds money until their account hits zero. What separates them isn't luck, intelligence, or some secret indicator nobody else knows about. It's the rules they follow, or more accurately, the rules one follows while the other ignores them completely. The difference between winning and losing in options trading isn't found in complex strategies or expensive software. It's buried in the discipline of following fundamental principles that most traders know exist, but somehow convince themselves don't apply to their situation. Let me take you through the rules that actually matter, the ones that separate the consistent winners from the revolving door of hopeful traders who eventually give up. Before you place another options trade, understand this fundamental truth: options are decaying assets. Every single day that passes, your option loses value due to time decay, what traders call theta. This isn't like buying a stock where you can hold indefinitely and hope it eventually goes up. With options, time is literally working against you if you're buying and working for you if you're selling. This single characteristic creates the first major rule that winners understand: never buy options without a clear catalyst and time frame in mind. Too many traders buy options like they're buying lottery tickets. They see a stock they like, buy some calls expiring in a week or two, and hope something good happens. This approach has about the same success rate as playing roulette. Winning traders buy options only when they have a specific reason to believe something will happen within a specific time frame. Maybe there's an earnings report coming up, a product launch, a regulatory decision, or a technical breakout forming. Whatever the reason, there's always a catalyst, and there's always a plan for when that catalyst doesn't materialize. The second rule that separates winners from losers is position sizing that actually makes mathematical sense. I've watched countless traders destroy accounts, not because they picked the wrong direction, but because they risked too much on a single trade. Here's what typically happens. A trader has $10,000 in their account. They feel confident about a trade, so they put $3,000 into one options position. That's 30% of their entire account on one coin flip. They might win that coin flip, maybe even win the next 3 or 4, but eventually that approach leads to catastrophic losses. Winners risk between 1 and 3% of their account on any single trade. That means with a $10,000 account, you're risking between $100 and $300 per trade, not thousands. This sounds conservative, maybe even boring, but here's the math that matters. If you risk 30% per trade, you only need 4 consecutive losses to be down more than 60%. At that point, you need a gain of 150% just to get back to break even. But if you risk 2% per trade, you can survive 20 consecutive losses and still have 60% of your account left to rebuild. The third rule involves something most traders get backwards: picking the right expiration date. Beginners almost always buy options that expire too soon because they're cheaper. A call option expiring next week might cost $50, while one expiring 2 months out costs $200. The cheaper one feels like better value, like you're being smart with your money. But that thinking ignores how options actually work. Short-dated options experience accelerated time decay, especially in the final 2 weeks before expiration. That $50 option you bought might need the stock to move 5 or 10% just for you to break even because of how quickly it's decaying. The $200 option with more time gives you room to be right about direction, but wrong about timing. Winners typically trade options with at least 30 to 60 days until expiration, and they close positions well before the final 2 weeks when decay accelerates dramatically. Here's a rule that sounds simple, but trips up almost everyone. Know your maximum loss before entering the trade. Not your hoped for maximum loss, not your theoretical maximum loss if you manage the trade perfectly, but your actual maximum loss if everything goes wrong. With options, this gets complicated fast because different strategies have different risk profiles. If you buy a call option for $300, your maximum loss is $300. Simple enough. But if you sell a naked put, your maximum loss is potentially massive if the stock goes to zero. If you create a spread, your maximum loss is the width of the spread minus the credit received. Winners calculate this number before entering the trade and confirm they're comfortable losing that amount. Losers figure they'll deal with it if it happens, and then panic when it does. The fifth rule involves something that sounds obvious but gets violated constantly: trade liquid options only. Liquidity in options is measured by the bid-ask spread and the open interest. The bid-ask spread is the difference between what buyers are willing to pay and what sellers are asking. Open interest is how many contracts are currently outstanding. When you trade illiquid options, you pay a massive hidden cost in the bid-ask spread. Imagine you want to buy an option where the bid is $1 and the ask is $1.50. That 50-cent spread is over 30% of the option's value. You're starting the trade down 30% before the stock even moves. Winners stick to options with tight spreads, usually no more than 10 cents for cheaper options or 5% of the option's value for more expensive ones. They also want to see open interest of at least several hundred contracts, preferably thousands, to ensure they can exit the position when needed. Rule number 6 addresses a mistake that destroys more accounts than bad stock picks: ignoring implied volatility. Implied volatility measures how expensive options are relative to their historical prices. When implied volatility is high, options are expensive. When it's low, they're cheap. This matters enormously for which strategies work. Buying options when implied volatility is high is like buying a house at the peak of a real estate bubble. Even if you're right about the direction, you can lose money when volatility drops back to normal levels. Selling options when implied volatility is low is equally dangerous because you're not getting paid enough premium for the risk you're taking. Winners check implied volatility rank or implied volatility percentile before trading. They prefer buying options when implied volatility is in the lower half of its range and selling options when it's in the upper half. The 7th rule is perhaps the hardest to follow because it requires admitting you're wrong. Always use stop losses or have predefined exit points. The human brain is wired to hate losses more than it loves equivalent gains. This creates a psychological trap where traders hold losing positions too long, hoping they'll come back, while cutting winning positions too quickly to lock in small gains. This is exactly backwards from what works. Winners decide before entering a trade exactly when they'll exit if things go wrong. Maybe that's when the option loses 50% of its value. Maybe it's when the underlying stock hits a certain price level. Maybe it's a specific number of days before expiration. Whatever the criteria, it's decided in advance when emotions aren't involved. When that line gets crossed, they exit. No questions asked, no hoping it comes back. Rule 8 involves understanding and respecting earnings announcements. Earnings reports create massive volatility in stock prices, and options traders see this as opportunity. But here's what usually happens. Traders buy calls or puts expecting a big move, and even when they're right about the direction, they lose money because implied volatility collapses after the announcement. This is called a volatility crush. Options prices before earnings include elevated premiums to account for the expected move. After earnings, regardless of which direction the stock goes, that premium evaporates. Winners either avoid trading options through earnings or use strategies specifically designed to profit from volatility crush, like iron condors or selling straddles. They don't buy calls or puts expecting to profit from an earnings move unless they're getting unusual circumstances that might overcome the volatility crush. The 9th rule addresses diversification, which looks different in options than in stock investing. Many traders think they're diversified because they have options on 5 different tech stocks, but if the entire tech sector drops, all 5 positions lose together. That's not diversification. That's concentration with extra steps. Winners diversify across truly different sectors and market conditions. They might have some bullish trades, some bearish trades, and some neutral trades that profit from time decay regardless of direction. They spread their positions across different expiration dates so not everything is expiring at once. They understand correlation and avoid loading up on positions that will all succeed or fail together. Rule 10 is about record keeping, which sounds boring but provides the edge that compounds over time. Winners track every trade with details: entry date, exit date, strategy used, underlying stock, implied volatility at entry, reason for the trade, outcome, and lessons learned. They review these records regularly to identify patterns in their winning and losing trades. Most traders have no idea what their actual statistics look like. They remember their big wins clearly and forget or downplay their losses. Without detailed records, you're flying blind, unable to identify which strategies work for you and which don't. Winners treat trading like a business, and no business succeeds without tracking its numbers. The 11th rule involves proper use of leverage. Options provide built-in leverage because they control 100 shares of stock for a fraction of the cost of buying those shares. This leverage is part of what makes options attractive, but it's also what makes them dangerous. Many traders see the leverage and think it means they should trade larger positions. This multiplies both gains and losses. Winners respect the leverage inherent in options and adjust their position sizes accordingly. Just because you can control $10,000 worth of stock with $500 in options doesn't mean you should treat it like a $500 risk. If that option goes to zero, you've lost $500. If you bought $500 of the actual stock and it went to zero, you'd also lose $500, but that's much less likely to happen than an option expiring worthless. Rule 12 addresses the critical skill of adjusting positions. Unlike stock trading where your choices are hold or sell, options trading often involves adjusting positions to change their risk profile or extend their duration. Maybe you bought a call spread and the stock moved up faster than expected. You might roll the spread up and out, taking some profits while keeping exposure to further gains. Winners know how to adjust, but more importantly, they know when adjusting makes sense versus when it's just throwing good money after bad. They understand concepts like rolling for a credit versus rolling for a debit, turning losses into different positions that have a better probability of profit, and when to simply accept a loss and move on to the next opportunity. The 13th rule is about understanding assignment risk. When you sell options, particularly short calls or short puts, you face the risk of being assigned, meaning the option buyer exercises their right and you're obligated to buy or sell the stock at the strike price. This can happen any time for American-style options, but it's most common near expiration for in-the-money options. Losers often get caught off guard by assignment, suddenly finding themselves long or short stock they didn't plan to hold. Winners understand exactly when assignment is likely, monitor their short options carefully as expiration approaches, and either close positions before assignment risk becomes significant or have the capital available to handle being assigned. They never sell options they couldn't afford to be assigned on. Rule 14 involves respecting market conditions and adapting strategy accordingly. Some traders have one strategy they use regardless of whether markets are trending up, down, or sideways. They're like carpenters who only own a hammer and try to use it for every job. In strong bull markets, simple call buying can work well. In high volatility, premium selling strategies shine. In low volatility, directional strategies often struggle. Winners maintain a toolkit of different strategies and deploy the right one for current conditions. They recognize when markets are range-bound and use iron condors or butterflies. They identify trending markets and use directional spreads. They see elevated volatility and sell premium. They don't marry one approach regardless of conditions. The 15th rule addresses something subtle but crucial, understanding how options pricing models work. Options prices are determined by several factors: the stock price, the strike price, time until expiration, implied volatility, interest rates, and dividends. These inputs feed into pricing models like Black-Scholes to generate theoretical values. You don't need to calculate these by hand, but winners understand the relationships. They know that as a stock approaches a strike price, the delta of at-the-money options is around 50, meaning the option moves about 50 cents for every dollar move in the stock. They understand that theta accelerates as expiration approaches. They grasp that vega measures how much an option's price changes with volatility moves. This understanding helps them choose the right strikes and expirations for their outlook. Rule 16 is about avoiding the trap of overtrading. Options trading can become addictive because of the leverage, the quick results, and the constant availability of new opportunities. Many traders feel like they need to always have positions on, always be doing something. This leads to taking marginal trades just to be in action. Winners understand that sometimes the best trade is no trade. They wait patiently for high-quality setups. They're comfortable sitting in cash when conditions aren't favorable. They recognize that preserving capital during unfavorable conditions is just as important as making money during favorable ones. The 17th rule involves proper use of spreads versus single-leg options. Many beginners start with buying calls and puts. As traders gain experience, they often move to spreads, which combine multiple options to create positions with defined risk and profit potential. Spreads limit maximum gain, but also limit maximum loss. Winners understand when to use each approach. Rule 18 addresses the Greeks. Delta measures directional exposure, gamma measures how fast delta changes, theta measures time decay, vega measures volatility sensitivity. Winners monitor these to understand their risk exposure and predict how positions will behave under different market conditions. The 19th rule is about avoiding cognitive biases. After several winning trades, many traders feel invincible and increase risk. After losses, they either become too conservative or start revenge trading. Winners recognize that each trade is independent. They maintain consistent position sizing and entry criteria regardless of recent results. The 20th rule is never stop learning. Markets evolve, volatility patterns shift, new vehicles emerge, regulations change. Winners study continuously. They read, take courses, analyze their journals, and remain humble. They adapt their approaches as markets change and aren't afraid to abandon strategies that stop working. The harsh reality is that most people who start options trading will eventually quit after losing money. Studies suggest between 70 and 90% of options traders lose money, but that doesn't mean it's inherently unprofitable. It means most traders violate enough fundamental rules that losses become inevitable. The winners in options trading aren't smarter. They don't predict the future better or have secret strategies. They simply follow disciplined rules consistently, manage risk properly, and avoid behavioral traps that ensnare most traders. Think about about the two traders from the beginning. The loser sees an option chain and thinks about potential profits. They buy options expiring too soon, position sizes too large, no real plan. They hold losers too long, cut winners too fast. They trade when bored, ignore implied volatility, don't track statistics, repeat mistakes without learning. The winner sees the same chain and thinks about risk first. They calculate maximum loss and confirm it's acceptable. They check implied volatility. They select expirations, giving their thesis time to work. They enter with clear catalyst and predefined exits. They maintain a journal and